Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL, and certification from NASM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.
Hello and welcome to the Quit Podcast. Today is a very special edition for us. There has been a bit of a break in our podcast recordings for multiple reasons, but we have been working in the background, and this special podcast is an example or is a outcome of the work that has happened in between. Today we have a very special person on board on the podcast. And I have, I don't know if I have the rights to or the strength to introduce Mr. Sunil Subramaniam. He is a doyen in the mutual fund industry. He is, he was my erstwhile boss. So, he retired recently as the managing director of Sundaram Mutual. He's been in the banking financial services space for as long as I can think of. He has been in multiple big organizations, including Bank of America, and Sundaram Mutual was his last corporate assignment. You can take a man out of the corporate, but you can never take a corporate out of a man. He is the most, genial, formal giant that I have seen work with. Thank you very much. Today is special, also because Mr. Sunil Subramaniam has gracefully consented to guide Dyota Solutions as an organization to its next level. There is a saying that what brought you here is not going to take you to the next stage. And probably we all either need a kick in the back or a holding hand, a guiding hand to take us to the next level. And Mr. Sunil Subramaniam is a bit of both for me. So very thankful for the opportunity to work with you again. Very thankful for the guidance you provide. And I wanted to use this podcast as A, to introduce you, B, to let the world know that we've got you as a guiding mentor for our organization, and C, also pick your brain a little bit on how to go about the investing process, because that is something which we fundamentally focus on. So you've been investing for a long time, Sunil. So I just wanted to understand, you would have seen multiple market cycles. According to you, which was the worst market cycle that you have seen or experienced? And what is it that a common man can do to prepare themselves for this ups and downs? I mean, as in terms of how they can plan their own finances to make sure that they don't get hit bad.
So thank you, Nanda, for that very kind introduction. I'm not sure I live up to all the things that you said, but anyway, we'll take it as it comes. So you've said that I've been investing for a very long time. So that's very true, because while you mentioned my stint at Sundaram Mutual, where I spent almost 19 years, I had spent an equal amount of time prior to that with two banks, State Bank of India, about 9 odd years, and American Express, 9 odd years. Bancam was a short stint of 2 years. The reason I say that, so I have been investing ever since I became a employee of State Bank of India, right? So my investing experience is double of my investment management experience. So since you posed the question to me as an investor, actually the worst cycle that I experienced was the Harshad Mehta scam, which was in 1992. okay, as an investor, right? As an investment manager, it was the 2008 global financial crisis. Okay. So since the question was posed to me as an investor, why I say this is that today, rolling back the years, I realized the value of understanding the investment management process, getting guidance from a person. Because in 1992, I was just at the fag end of my stint with State Bank. I left there in about a year later, right? And I'd been merrily investing, and as is typical, I would say, even of the modern day investor, into random stocks based on tips. So I had a full portfolio full of paper, which today even the Radiwala will not pay a value for that. But they are still lying. I haven't even bothered to demat them because the cost of dematting is more than the value of the cake. But as an investor, that's the time I really felt it, that suddenly the bottom had fallen out of it. Because every investor credits himself with intelligence, with superior knowledge. Even though you may be relying on tips, you think that you, on top of the tip you have applied, you read as a read about it, right? And being in the financial services domain, you think, oh, you have the cat's whiskers because you know balance sheets, you know lending. So you think you understand companies, right? But the stock market is a very, very different animal. And that was a rude shock to me at the Harshad Mehta scam, because a scam can occur and we think that those companies, I never invested in any of the Harshad Mehta stocks. But still my portfolio completely dissolved, disappeared, right? So it taught me a big, big lesson that when negative events occur, everything goes down. So that, oh, I have a superior thought process, superior thing, does not hold water at such a time when such an event, market-wide event takes place, right? But at the same time, right, I did not out of any great foresight, I did put my money in a few mutual funds also parallelly, right? Which also I shut in the cupboard. Now, those have become 30 to 40 times their value, whereas the stocks I've got are not worth the paper they are printed on. So then that's the realization that if you stay invested in a broader thing, right, during such a crisis, your portfolio will definitely suffer. But ultimately, because you are giving the reins of your portfolio management to an ex-advisor, stroke manager, to somebody, they absorb the loss and come up with their understanding. I'm sure their portfolios also suffered. So my mutual fund NAV also suffered. But since I did not do anything with either my stocks or my mutual funds, my stocks never rose up because they were entirely based on certain tips and I know my own understanding. But the mutual funds were in the hands of managers who rejigged the portfolio post the crisis, right? And made sure that that crisis has not had an impact on my mutual fund in terms of the rewards that I've got. So I think the lesson to me is, I guess this is an oft-used word called diversification, but that diversification on my own, because if you ask me, I owned about 50 separate stocks. It's not useless because they were all from different industries. So meaningless diversification doesn't matter. It has to be diversification with application of investment management skills, which can happen only with an advisor stroke this. So my learning from that was that stay away from stocks. Okay, very important, because I just don't have the necessary skill set to build a properly diversified portfolio of stocks, because we are all driven by this balance between fear and greed, right? And diversification is the best protection against that. But when we do diversification ourselves, we choose various levels of greed as our diversification portfolio. At no point should we go and choose a fear. At no point do we go and say, this stock has fallen 150% or something, I'll go and buy it. No, that emotion doesn't allow us to go and bet on what we think is a losing horse. But whereas yesterday's losing horse could be tomorrow's winning horse. So that true diversification, to buy what your common sense, your emotions tell you not to buy, is what I think is my biggest learning from this.
Brilliant. I mean, I can never imagine, Mr. Sunil Subramaniam say that, I don't know how, pick a stock. And please, take the help of a fund manager or an advisor. I mean, this is golden words out of a person who has spent, years, decades as an investor and in the investment management domain. I mean, you were speaking about Harshad Mehta's scam in 1992. I was not even out of college. I was probably, in a tracksuit with a notebook, cycling my way to college. By 2008, I was hit too, right? So, if you have not seen more than one market cycle, then you're not a big investor, or you don't have too much data to, talk about. So that way, coming from Mr. Sunil Subramaniam, I think it's a fantastic advice. So, sir, now begs the next question. If you are now a 23-year-old, right, what would you do differently? So you did speak about stocks, you did speak about mutual funds. What would you do differently to make sure that you are navigating this kind of a scenario? I'm just trying to.
See, the 23-year-old today is different from a 23-year-old when I was 23 years old. Okay, right. The reason is today technological advancement, right? Search engines have all changed so much that actually the situation has got worse. When limited access to information is, if I felt that I was a king at selecting stocks, right? Today, there is enough ample thing that you can go and do and ChatGPT search, you can do something and still say that, oh, my basis of my evidence says, I think this stock is a winner, right? But unfortunately, right, the difference between the situation then and now in terms of selecting stocks versus selecting a diversified portfolio managed by an advisor stroke manager has not changed at all. The fundamentals of investing haven't changed.
Oh, yeah.
To that extent, what I would suggest is, but merely giving a textbook advice to say don't invest in stocks, I think that's a textbook advice. Because when we give advice, it has to get through the listener. Advice which has not listened by the listener has no value. You may satisfy yourself that I gave the right advice. So my answer to that question is that to the 23-year-old is that you have the information, right? You have the thing. So use that information. First of all, do not ignore any asset class. Okay. So you want to put in stocks, you put it. You want to put in crypto, you put it. You want to put in gold, you put it. You want to put in mutual funds, you put it. But what you do is you limit your upside and downside by choosing a very diversified asset allocated portfolio, right? Where then and once you do that, you yourself will get the evidence when you're 24 years old and 25 years old and 26. You will have the 1 year experience of each, how one of those went through. You will then learn. So my answer to this is not to say, hey, listen, I made a bad decision about stocks, so please don't invest in stocks, versus invest in everything, but balance your approach so that you give a chance to advice, you give a chance to management, you give a chance to different assets, all of it, right? And use your technological skills to choose the best form in each of those asset classes. So use the research to choose the best mutual fund, use the research to choose the best advisor, use the research to choose maybe the best form of investing in gold. So the point is, use that well, but the core aspect of diversification doesn't go away. So I would say diversify, and to the extent of your risk appetite, you load on the riskier assets. So a 23-year-old, all 23-year-olds are not the same. There are conservative 23-year-olds and there are aggressive 23-year-olds. So the port that you put into a risky asset class like a crypto will depend on your risk appetite. But it can't be 100% in crypto. That is my suggestion. My saying is that understand that, right, information is plentifully available. The world is an open book exam. You need to know where to look for what. Use that, but do not forget that there is no soothsayer or Nostradamus or a prophetess or a Vejan Daruwala who can tell you what performs well in the future. And the answer to that is to diversify. And when you choose the level of riskiness in your portfolio by stocking up on the riskier assets more versus the less risky assets based on your own risk appetite, which is the one part where an advisor proves useful, because it's very hard for people to judge their own risk appetite, because the situation you mentioned, the crisis, in a boom time, everybody thinks that they are got the risk appetite to do anything. In a crisis, they lose all their risk appetite. So the true assessment of the self probably is best left to a third person that you trust.
Brilliant. So actually, I also take a personal lesson in there. I mean, I tell not just my clients, including my son, I tell him, don't do the mistakes that I have done, which kind of takes away the opportunity for him or my client to make a mistake. So what you said, I take a brilliant lesson from there. Maybe use 23 to 26 to make the mistakes, but make it in a measured way. Find out for yourself what suits your requirement. Use the research properly. Use the research for whether it is stocks or to find an advisor or to find the mutual fund, and then have a diversified plan. Thank you very, very much for the personal lesson as well. And you also seem to have touched upon one very, very important point here, which is the role of quality advisors in building a retirement corpus. So since you touched upon that, I would want to get to that immediately, sir. What do you think is the role of quality advice in building a retirement corpus, which is the most fundamental reason why people have to invest?
First, I would like to define the role of an advisor, and I would like to take an analogy from a different industry, right? And this is not something that you may be familiar with because it's before your time. Okay. In the days that I grew up, right, every family in India of a middle class and above had what is known as a GMP, a general medical practitioner.
Absolutely, sir. I was there, sir. I'm old enough.
Why do I say this is that unlike a specialist doctor or a surgeon to whom you go when you have a serious problem, right? You go to a kidney specialist if you feel you have a kidney problem. You go to a heart specialist when you have heart. You go to a diabetes specialist when you have sugar spikes up. But the general medical practitioner was your friend, philosopher, and guide for everything in the family. So, konjo lightest headache, you'll pick up the phone and call him, right? And if you didn't have anything also, you'll pick up the phone. And his role was that a bunch of placebos would be in his portfolio, which he would give to you. But the mere fact that he gave it to you, but the important point was that he listened to you through your problems. And he listened and he understood where you're coming from. He would, in his own judgment, judge whether this is a hypochondriac issue or is it a real issue, and accordingly give you something to go away with. But very rarely would he say, I'm not giving you anything. He would give a placebo. You have this, it'll be okay. So why I'm saying this is that unfortunately that profession has died today. That has been replaced by the pharmacists at the drug pharmacy. So now, right? But that's where I would see the role of an advisor is that first he listens to you. One. Second, he judges you on your risk-taking capacity. Two. Three. What he does is he tries to balance your emotion versus the logic, right? Because we all in our decision-making process have a blend of logic and emotion. Even the most studied fund manager, most experienced fund manager, emotion comes in, maybe the levels of it differ, right? But most of the mistakes which happen come due to emotion dominating logic, right? And when logic tries to overtake emotion, you build a safety wall, right? So the job of the advisor is to present you with a logic. It's not necessary that the logic will convince you. It depends on the depth of your emotion. But he presents that guiding light, right? So that's his other role. Then what he does is he also makes you clarify as to what's the purpose of this exercise that you're doing with him, right? Because we use the word investing in a very haphazard and loose manner. Not every money that I go and put into something is an investment. Where I buy crypto, it's for the sheer sexiness and the excitement of crypto, right? Otherwise, if I do something that's like, a defense stock, I feel that the sentiment is going, I'm doing it. I just do it because I don't want to miss out. So the FOMO factor comes in, right? Fear of missing out. So whereas his role there is to make sure that everything that you do, he gives you a certain limit to doing things without purpose, but he tries to push a majority of your decision making with a purpose in mind, with a goal in mind. So blending is assessment of your risk, understanding your family to understand what are the familial needs which are likely to come in the future, and trying to anchor your investments to the achievement of that makes a very purposeful investment. So I think the biggest role of him is that you put logic, rational, financial planning, asset allocation, choosing the right assets at the right time so that you make your investment a worthy experience. A worthy experience means there was a goal set and that goal was achieved with the help of this investment process. And so that you set your emotions aside and let the goal decide when you should redeem. So the role. And one final role is that just like the general medical practitioner, is that his job is to understand your finances and your needs better than you do. Why do I say this? Is that we are all, as married people, all of us have been guilty about forgetting our spouse's birthdays or wedding anniversaries at some point or the other. It's his job because he's calendarized it to make sure that a week before your wife's birthday, he redeems your money and gives it me 2.5 something. Why I'm saying this is he has that objective outcome where he's got a single-minded purpose of managing your finances. Whereas you have, managing your finances is one of the multifarious things that you're doing in your life. You're watching cricket, IPL, to watching movies, to going to work, to having a drink with your friends. All of this this whole melee comes in fits. Whereas his goal is to make sure that your finances are used appropriately, which is reward your near and dear at the right moments. So that's where an advisor's role is absolutely crucial, because just as in this modern day, you tend to go and do it yourself medicines, right? You go and Google it, say, I have this stomach pain, then you go to the pharmacist and say, I have this, and take a tablet, right? There, you are harming your health that way. Here, if you do it yourself, you're likely to harm your own future. You'll end up with saying, I did a lot of activity, but where have I got? I'm back at the starting point. So I think it's essentially, to summarize, right, is to make sure that you have somebody who listens to you, looks at an objective view of your finances, understands your emotions, and helps you use the stock market and the tech capital markets to achieve certain purposes in life, some of which you may be aware, some of which you may not be even aware. So I think that's the role of an advisor, for which I think that, not enough credit is given by the lay public in terms of this.
Brilliant, sir. I still remember Dr. Anangachari in Tinagar. I'm a Chennai boy who used to have a pink syrup. Pretty much, it was like a Sarvaroga Nivarani.
Called Miss. It was called Miss. They'll give you the.
Yeah. And then he will know exactly when to send me to a specialist. Otherwise, things were, fit and fine. Right. So great, brilliant analogy. And thank you very much for bringing that nostalgic thought process as well. And finally, sir, you've been in the active fund management space over the last 19 years, right? And there is this, something that has been there for a long time, but suddenly that is also becoming a little sexy, so to speak. Index-based investing, right? What are your views? What do you think is the way forward for index-based investing? And how do you see this concept coexisting or growing beyond where it currently is?
Okay, so for that, I just need to explain the stock market a little bit to your the public who are listening to this podcast, right? So why do you at all invest in a stock market, right? There's only one fundamental reason for that, is that the stock market is the only vehicle in the market which correlates to inflation. And so the purpose of investment, I like to define investment as a postponement of consumption. Then what buy today? You're saying, no, I will not buy it. I will save it or invest it so that I can buy a better thing tomorrow. You're postponing that investment. That's consumption, right? Ultimately, your money is going to get consumed. Of course, you will leave a bequeath, something for your children and grandchildren that will not be spent. But that's also a use of the money, right? So the point is that, right? So why I'm saying this is the stock market is geared to deliver to you inflation beating return for one simple fact that inflation hurts the buyer of products, benefits the seller of products. As simple as that, right? And these seller of products, a portion of them are listed in the stock market. And because to get listed in the stock market, you have to be the creme de la creme, the ipso facto assumption is that they take a larger share of a cost increase as their profit increase.
Right.
Simple logic. So the stock market actually houses most of the inflation benefits in itself. And so by investing in the stock market is where you are now participating in the person who is ripping you off in your daily life by buying a piece of him in the stock market. Simple. Okay. Right. So even that logic, right? If you had a very simple question that I just want to be able to buy a lot of things in the future which I can't afford today, all you have to do is simply buy the stock market. You don't have to do anything over it. Now, what is the challenge to that? The challenge to that is this whole concept of emotion versus logic, the concept of fear and greed when it comes to emotion, right? Because we don't set those long-term goals in our own self. Whenever there is greed in the market, we'll put more money into the market. Whenever there is fear, we'll pull out our money, losing sight of the longer term thing, right? So we had simply trusted the index. Any individual in living in our country over the last 10, 15, 20, 25, 30 years would have amply beaten inflation. And the simple way to compute that is that when I said broadly that the companies benefit from inflation, right? The companies also benefit from the growth of the nation. Right?
True.
Growth of the nation is expressed as the GDP growth that you see. Right? And that is simply called as a real GDP growth. And to which you add the inflation, you come up with a real GDP growth plus inflation equal to nominal GDP growth. Okay? Now, historically, see, India has had a roughly 10% nominal GDP growth. Okay? 6 to 7% has been. And a long term, while inflation in certain classes has been 7%, a computed inflation generally is around 3 to 4%. So, given that, around 10% has been nominal GDP growth, but the stock market has delivered 12 to 14% broadly, right? So, in a manner of speaking, nobody needs to have done anything other than index investing to have achieved their postponement of consumption to this. But what comes and spoils that is the greed. Is that stock market on its own course may help me to buy, let us say, a Mercedes Benz. But then you want to now buy a Lamborghini, which that stock market may not have done it, right? Because we're all humans. So the point is that everybody then says that where can I maximize? Because the world is also that there's always an opportunity cost and opportunity return. So the world always tries to seek a maximizing of opportunity, right? So the whole concept of active fund management came saying that the broader market is a blend of hits and misses. Right? What if I use superior logic, rational study to pick a greater proportion of the hits and avoid a greater proportion of the misses? That is the concept of active fund management. Okay.
Brilliant.
Right? Now, the question is that what leads to this ability to pick better amount of hits and not pick greater amount of misses is this thing called information asymmetry. I'm sorry to have introduced a jargon word. I try to avoid it all this while. The information is nothing but the thing that the only way you can pick that money in the stock market is by knowing something the broad market does not know. Right? Or knowing something before the market comes to know. Right? Now, obviously, the extreme of this is insider trading, where your brother-in-law is the CFO of a company, he knows this is going to happen, and you go and buy the stock. It is illegal and different. But there are ways to have superior analytic skills to pick the winners, right? Which are the way you do it in two ways. First is all indexes are a subsegment of the market, right? Even Nifty 500, which has 500 stocks, is a subsegment of a 3,000 stock market, right? So there is no index as such, which is the entire market in itself. Okay, even the Nifty 500 is the most broader index or whatever, still is a small proportion of the overall market, right? So how has active manager tried to deliver a better return than the passive index by picking some stocks which are not in the index yet, which could grow faster than the index, and two, by sizing the portfolio. That is, if the index has a good stock at 10% weightage, he can choose it at 15% weightage so that better stock he does. So this is the essence of active management trying to do, right? So when that happens, right, what the evidence internationally says in developed markets is that information asymmetry lasts for a very few seconds in developed market because information is immediately translated. So internationally in markets like America and Europe and all of that, active fund managers have found it very hard to consistently beat the index because whatever they have, that advantage of information asymmetry vanishes in seconds. So unless they act in a hyper quick manner, go do it and do all of that, it doesn't work. So that's the developed market story. In a developing market, because our information always comes with a lag, there's not a proper documentation of data, there is still an immense scope for a fund manager to use information asymmetry to deliver alpha, right? Now, that's one way to deliver the alpha. So active management has its role to play, which is what I was doing for 20 years or almost of my life. It has a role to play in countries like India where it can deliver value. But part of the value which the active fund manager does is not just by information asymmetry, it's also does by asset allocation. With choosing, like say you put it into a flexi cap fund, right? How much of, in addition to picking the stocks with an information asymmetry, he picks the large cap, mid cap, small cap, or multiple sectors, right? In choosing that which in a given time frame would outperform the rest, right? It's not just information asymmetry, but it's a read of the future. It's reading the tea leaves to say what's happening in a macroeconomic world and correlating it to that, right? So that's also a part of the alpha generating process of the thing, right? So now what's happened is that ability, right, has got lessened with the time for one simple reason is that 20 years ago and 30 years ago, right, there was just one Nifty 50 passive fund. And see, but over a period of time now, you have so many passive funds which are sub-tracking sub-indices. So you have small caps, you have this, you have momentum, you have value. So you name it, the chunk of the market, the slice of the market, there is a passive fund noted. So the ability of the fund manager to do this asset allocation now effectively can be done by another doing passive investment. So what you do is, so then what happens is that sometimes the asset allocation can prove superior to stock picking because stock picking is essentially dependent on the inflation asymmetry, which is slightly fading away. And what proportion of the alpha comes from asset allocation, what proportion comes from stock picking varies from fund manager to fund manager everywhere. So it's very well possible for a asset allocator to choose the right sort of allocation and maybe outperform an active fund manager because he made the right calls at the right time.
Really?
Second aspect to this is that there is also this theory, right, in a very simple English to put, is that what goes up must come down, what goes down must come up. So another way this thing works out is to be a consistent contra investor, right? You say this has gone down. What's the advantage? You say that ultimately it will come up. Maybe the time frame decision making is different for different people, but it will ultimately come up. That's the rule of the market. But what happens is that when you're buying something that goes down, ipso facto, you're buying something that has become cheaper. Other fundamental feature of the market is buy low, sell high. So a combination of asset allocation and doing consistent, choosing the right contrast at the right price, because the contrast may keep falling. Do you catch a falling knife which is going to fall further, or you buy little of it on all the way down, or you buy it at the extreme bottom? These are all skill set issues. But today, the passive investing has seen a major leap, partly because asset allocators are able to go there and choose a right set of index funds. And one thing which I want to disabuse people's notion is that you use the right word to say index-based investing. I'm glad you didn't say passive investing. And I'll tell you why I'm saying that. There's a nuance here. Because many people assume that indexes are passive. They're absolutely not. Every index is rechecked every 6 months. So the stocks that you have in the Nifty 50 30 years ago, none of the stocks are in the index today. So the index itself is actively managed by the index provider. So it's not that you're buying very often people mistake passive to say buy and hold it. No, you buy and hold the Sensex. The Sensex itself has immuted over time, right? So to that extent, right, active asset allocator in various index takes cognizance of what's changing within the index. Because how does a stock make it to an index? A stock makes it to an index by kicking out another stock from the index.
Absolutely.
How does that happen? Because an index has a limited number of stocks, Sensex 30, Nifty 50, or whatever. So how a stock comes into the index is based on many, many factors, but it's market cap, for example, free float market cap. Now, a stock which has run up rapidly enters the index. But a stock which goes out is that which is not runnable. But that's the very thing which makes contra investing worth it. What you can do is, when you then study the index as an asset allocator and look, saying this stock has entered, but it's already had a run up. It's now entered the index. But there's another stock which has come out. So can I choose another index where that stock is present? Because then my contra, I will play through that. So that is where the importance of asset allocation in an active manner, even within assets. So index-based investing with the help of an advisor can be an active management of your portfolio without necessarily using the choice of stocks as your way to generate alpha.
Brilliant. Sir, I wouldn't have been able to explain this myself despite, I don't know, for some strange reason, you apologized for using a jargon, but despite using one jargon phrase, I think I wouldn't have been able to explain this myself. And thank you very, very much for explaining this so beautifully. Thank you very, very much for the opportunity. I really look forward to working with you very, very closely in the coming months and years, and growing as part of this process. Hopefully touching a lot of lives. Many, many thanks for the opportunity, sir. Thank you very much for your time.
Thank you. And all those who are listening to the podcast in a very happy investing journey.
Thank you. Viewers, listeners, thank you very, very much for joining us today. Once presenting Mr. Sunil Subramaniam, we hope to grow with his advice and with all your support. Thank you very, very much. See you soon. Namaskar.
So that was today's episode. Thank you very, very much for listening in. We hope to see you soon. This podcast is intended to provide helpful and informative material on the subject matter covered. It is given with the understanding that the podcasters of this material are not engaged in rendering professional services through this program. If the listener requires personal assistance or advice, a competent professional should be consulted. The podcasters specifically disclaim any responsibility for any loss, liability, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use of any of the contents. The contents are general information that is intended to, but not guaranteed to be correct or updated. The information is not presented as a source of investment, insurance, or legal advice. You should not rely on the statements or representations made in this podcast or by any externally referenced sources. If you need investment or tax advice upon which you intend to rely in the course of your financial and business affairs, please consult a competent, independent, registered financial advisor. The content should not be taken as financial advice or as an offer to buy or sell securities, insurance, funds, or any financial products. It should not be taken as an endorsement, recommendation of any particular company or individual, and no responsibility can be taken for inaccuracies, omissions, or errors. The information presented is not to be considered as investment advice. The podcasters do not assume any responsibility for actions or non-actions taken by people who have listened to this program, and no one shall be entitled to claim for detrimental reliance or non-reliance upon any information provided or expressed herein. Your use of any information provided herein does not constitute any type of contractual relationship between yourselves and providers of such information. The podcasters hereby disclaim all responsibility and liability for all use of any information in this program.